All right. Welcome, everybody. Got to get this Sharon. Sharon is Karen, chapter 2. Here we go. Boink. No, really. Come on. All right, finally. Here we go. Oh, click that. Okay. So we've gone over chapter 1, and chapter 1 had primarily dealt with kind of just hey, here's the profession is what we look for. Here's your principles, assumptions, and constraints, different areas that we kind of went in a little bit more in depth on. So if you haven't noticed already, the intermediate accounting is we're starting to get closer to the ground. Okay, we were at 1,000 feet when we were doing accounting 111. Got to maybe about 7,000, or what did I say, 1,000 feet? That's hardly off the ground. You get what I'm saying? We're closer to the ground. We're getting closer to some more details and things like that. And that's really what intermediate accounting is. By the time you get to financial or to advanced accounting, it's going to be like, dude, okay, scenario based. Here's the scenario. What do you do? Here's the scenario. What do you do? And you'll be all right. You'll get it. So, all right. Make sure I got my water. Got dogs. I don't know, man. He's sleeping somewhere. Okay. Let's talk about this. We're reviewing the accounting process. So most should be stuff you've at least heard about, if not have a pretty good idea of what's going on here. We have a situation happen. Could be external, could be internal. Something happens. We have to evaluate it. That's basically what we're saying. An economic situation happens. We need to find out what has happened to make sure that if it's happened, does it impact the transaction? Do we need to do something? Does it involve our assets, our liabilities, our equity? Remember, our assets are our resources, our liabilities and equity are our claim on those resources. And the accounting equation must always balance, and each event or transaction has a dual effect on the accounting equation. Always double entry accounting. All right. Here we go. Remember, our shareholders' equity breaks out into our paid in capital plus retained earnings. There's some other accounts too, but bottom line is those are your basic ones. And then your expanded accounting, also your retained earnings is your revenues and gains added together minus your dividends, losses, and expenses. Okay. Generally speaking, there's other things that may impact that, but that's what you got here. Okay. Now, I don't know if my video, because let me see if I can pull my video, make it bigger or something here so I can see me. It's not. Okay. So I got me this thing. And I love this thing. I've been looking for one of these forever to do this exact thing. Okay. Remember, we got to stay in balance. So debits on the left, credits on the right, assets on the left, liability shareholders on the right. Either way you want to look at it is fine. My microphone. All right. So every single time we have a situation, all right, here we are balanced, right? It's not perfect. It's not like a perfect situation here, okay? But we have $50,000 of actually $50,000 of assets. Boom. All right, we're out of balance. Stockholders' equity. Let's say we have some liabilities, and then we have some stockholders' equity. All of a sudden, we're back in balance. As long as they equal, they're equal. I gotta figure out how this thing will balance better. Like I said, this is supposed to be something that you look at just as a prop or something. I want to use it functionality. Let's see if I can get it to actually go like that. So that's a little better. It's not true because the weights are, whatever. It's also on a book, and anyway, yeah, you get the idea, I hope. Okay. So remember, got to keep this stuff in balance. Got to keep it in balance. All right. Keep it in balance. You should show you guys that video. Debits on the left, credits on the right, debit left, credit right. Oh, complete satisfaction. Okay. All right. So received cash of 50,000 and issued common stock to investor. All right. Paid in capital, just common stock, and your assets, $50,000 cash, both go up. Okay. 40,000 was borrowed from the bank, cash goes up, asset, liabilities goes up, both sides. We buy some supplies on account. So we owe 3,000 and we got 3,000 in supplies. Okay, paid 1,000 on account, supplies. No, we paid for some of the supplies, what we did. That should be a negative. Dumbasses. I mean, sorry, clicked the wrong button. This one here, That should be a negative. They screwed this one up. Paid 1,000 on account to supplies vendor in transaction 3. So we should minus cash and minus liabilities. This is wrong. Should be a minus. I didn't catch that. My apologies. Okay. So we provide services for $10,000. Our revenue goes up. Our assets go up. We are owed the money because it was on account. The person's going to pay us $10,000. Okay, we got a bill. We didn't pay it yet. We just got the bill. Oh, for the love of Pete, you got to be kidding me. All right, it's either 5,000 or 500, but either way, it stays in balance. But we incurred, but did not pay utilities cost of 500 for operations in the current period. Okay, we decrease $500 utilities expense, or at least we decrease the equity. The expense account is increased, but that increase in the expense decreases overall equity. So we subtract out that, and we add what we owe on our liabilities. Paid dividends, 2,000 to shareholders. We're going to subtract out our retained earnings and our asset of cash. Here's our debits and credits double entry system. Here we go. Okay, T account. Debits on the left, credits on the right. I don't know if I'm mirrored or not, but you get the idea. Account title at the top. It's going to be whatever the account is. You should remember this. I'm hoping you have not lost this. Okay, debits on the left, credits on the right. Normal balances, assets, expenses, losses, and dividends are a debit increase. Liabilities paid in capital revenues and gains are a credit increase. Opposite is true for that one. So if we borrowed $40,000 from the bank, we're going to debit our cash because that's going up. Credit our notes payable, 40,000. Notice it's notes payable, not accounts payable. We borrow from the bank, it is a note payable or a bond payable. If no, it's bank's not going to give us a bond. We're going to give them notes. We're going to borrow them if it's not yet. Okay. Here is a breakdown of all the things that you would need. Okay, remember the contra accounts are going to be opposite of whatever it is. If it's a contra asset account, it's going to increase with the credit, decrease with the debit. So whatever all the other ones are. So if you have accumulated depreciation, that's a contra asset account. It's going opposite, but it's with the assets. Steps of your accounting cycle, right? Again, we went through these. You should have gone through these in your prior courses, so that should be obvious. That should be what you are familiar with. If not, then you need some remedial work. Okay. All right. So obtain the information, do the analysis on a transaction. First, find out if it's even going to need a transaction. Then, once you realize it does, find out what the accounts that are going to be impacted by it. Record it in the journal entry. In the general journal, or God forbid the special journals are rearing their ugly heads from chapter 7 in the last book. Step 4 is we post from the journal to the ledger accounts, which are the T accounts. When we post from the journal to the ledger, we're posting from the journal to the T accounts because the T accounts are represented by the ledger. Okay. For the transaction in the journal, I was behind. I didn't click the button before. I'm sorry. There it is. That's what I was talking about. And then prepare an unadjusted trial balance. Do your adjusting entries, adjusted trial balance, financial statements, closing entries, post-closing trial balance. Now, there are some aspects that if you need to, you can do reversing entries, but I don't ever go over those because seriously, I can't fathom why people do that. It's the weirdest thing, but some people do. I even knew a company that did. I like it. All right, we're gonna look at all these transactions. Okay, I may not go through them all, but we'll go through as many as we can. 2 individuals invested $30,000 in the corporation. Each investor was issued 3,000 shares of common stock. Okay, so each individual, we're getting $30,000 cash from each person. You got to be careful about that. So we're getting $60,000. We're going to credit common stock for $60,000. Now the question for you is can you come up with the par value here? We got 3,000 shares for $30,000 cost. We can't come up with par value because we don't know if, well, we assume that we can actually because it's not additional paid in capital. So it's basically looks like it's $10,000 per share. So that's a pretty pretty big company there to be getting that kind of I'm sorry, not 10,000, it's $10 per share. $10 per share, my bad. I don't know. I needed to carry a couple zeros there. $10 per share. That's what our common stock is at for this situation. If there's additional paid in capital, we could figure that out then at that point. But just interesting thing to look at. Now the company borrowed 40,000 from the local bank and signed 2 notes. The first was 10,000, has different interest information. Second one requires payment of principal in 2 years, interest and stuff like that. Interesting, right? It's the kind of stuff we got to deal with now. It's not always just so cut and dry. And it's also in July 1st, could be, April 3rd or something like that. Though we're debiting cash, crediting notes back. Okay, next one, paid 24,000 in advance for 1 year rent on the store building. Not many people are going to pay in advance for a whole year. Okay, good for us. We're doing that. Probably not really going to do that. Prepaid rent debited 24,000, credit cash. Purchased office equipment from Etronics for 12,000. Debit office equipment, credit cash. Okay, I'm not going through all the process here. This should be like you should be going, oh yeah, oh yeah, oh yeah. I get that you guys have been in 212 and now you're jumping into this after that. But there should be a lot of familiarity to this. If you're needing some extra work on this, my recommendation is do that SmartBook assignment a couple times. Okay, I highly recommend. You've got to remember this stuff because again, as you can see here, we're going through basically chapters 1 through 4 from the book I taught out of in one chapter, well, kind of 2, I guess. But then we're just jumping into new stuff after that. So it's important that you get yourself right this week. Okay, we bought inventory. We got our debit to inventory. We owe it. We didn't pay for it yet, so credit to accounts payable. Now, when we're dealing with this inventory, we have to think about something here. Are we dealing with the perpetual or the periodic? Okay. If it's perpetual, we're going to constantly be updating things. If it's periodic, we're going to do it at the end of the reporting period. Okay. Remember those 2 systems. Then we purchased $2,000 of supplies for cash. Then we sold some inventory. Did it say what method we're using? Did it say? Oh, it didn't. Okay. Sold clothing inventory during the month for $35,000 cash. The cost of the inventory sold was $20,000. All right. So this entry reflects the perpetual inventory approach. All right, cool. All right, cool. So we're gonna debit cash, credit sales revenue, and then we have to have an inventory side. That was our sales side. Our inventory side is debit to the cost of goods sold. Cost of goods sold acts as an expense. Inventory credited because we no longer own that inventory. Okay. Whoops, I hit the wrong button. Wait, I still went forward. No, I didn't. Okay, here's the next one. Sorry. We sold clothing inventory on account to Briarfield School. 3,500 cost was 2,000. Okay, I'm just curious. It is. It's the same cost. So we've only bought one, so that makes sense. One set of inventory. Okay, so accounts receivable 3,500, sales revenue 3,500. You got the journal entries. I'm looking to see if the dynamic was the same because it looks like it doesn't tell us how much our profit is going to be. $15 for whatever we sell, looks like, is our profit margin. Sorry, I was just thinking that through. Subleased a portion of the building to a jewelry store, received 1,000 in advance for 2 months rent. Okay, so we're going to have our debit to cash, credit to deferred rent revenue or unearned rent revenue, whatever. Looks like this book calls it deferred. That's fine. Unearned and deferred are both the same thing. Well, hold on a sec. I got to be careful how I say that because deferred expense is prepaid, so we can't do that entirely. So you got to be careful. But when we have a deferred revenue, it's an unearned. We haven't earned it yet. We got the money, but we haven't earned it yet. Okay, so then we paid the 25,000 we owed our supplier. So we debited accounts payable, credited cash. You can pause these at any time. I'm just going through them, right? You can look at them. You can pause it, look at it, think about it. Paid salaries to employees for the first half of the month. Oh, good. They're a 2-month check, 2-month paycheck, two paychecks per month. Received $1,500 from Briarfield. I think they owed us the 3,500, so it's about, it was another 2,000, I think. Like I said, these things should be like, boy, man, I remember this stuff now. Okay, the corporation paid its shareholders a cash dividend. So we paid our dividends, or the company paid dividends to our owners. 2 of them, right? All right. So this is the example of posting, right? When we got that prepaid rent or something. It's just an example. It's not even what we really did. We took those and we put them in the cash ledger and the prepaid rent ledger. That's just an example. Here is our ledger. It's super small. If you need to see the alternative, access the alternative slides, please click on this link here. You should be following along in these slides as we go. That would help you a lot. You can take notes and do stuff, but like if I click that, oh, this summarizes. So basically it reads it for you. So no worries. Okay. Anyway, and then here is your income statement account. So these ones are your balance sheet. These are your income statement and statement, well, dividends. Yeah. Why does it show dividends twice? That red dividends should be shareholders' equity. Whatever. Sometimes. Okay, so now we got to prepare the unadjusted trial balance. All we got to do is make sure, first of all, we list all these accounts on the balance sheet and the income statement and statement of owner of stockholders' equity. Make sure that they balance. Okay, just like we did with that weigh scale. All right, we list all the accounts from our general ledger, show their balance, and we see that we indeed equal. So that is our unadjusted trial balance. Then in step 6, we got to post our adjusting entries to our ledger. So whatever adjustments we got to make them, right? Stuff that happened that we didn't have something trigger. So we got to look at all of our prepaids and accrued liabilities, accrued receivables, and unearned or deferred revenues. Got to look at all of them, and even our estimates too. Got to look at everything. So our prepayments, stuff that we paid later, or that we either got or paid today, and we're not going to record it till later. Well, some of that stuff may have happened. So accrued liabilities for expense, accrued revenue, receivables for revenue. Got to look at our estimates, which is usually depreciation, bad debt expense, our prepaids. Okay, this is what's going to impact our financial statements. Pause the video, look and see, and kind of really, understand. All I'm going to do is read this slide. Otherwise, it is what it is. It's just there. Okay. Adjustment for supplies, prepaid expense. Got that information on this slide. And then, so we made the adjustments. It says the Dress Right Clothing Corporation purchased 2,000 supplies in July. Assume that Dress Right determines that at the end of July, 1,200 supplies remain. So we got to adjust that. If we have 12,000 now, we bought 2,000, we used 800, make the expense. Again, this stuff should be just a reminder. This whole chapter should just be reminding you what to do. Rent expense, prepaid rent. I think we prepaid it for the 1 year. Well, this is a month's worth. It's $2,000 a month. Okay, we did a month's worth of depreciation here, I think. Worthless at the end of that period. So we just take 12,000 divided by 60 and get $200. Okay. But I'm not trying to. Treasury paid 24 in cash. Company could have debited rent expense instead. No, it couldn't have. No, it couldn't have. This is stupid. I don't even know why they're doing this. It's blowing my mind. So they're basically they rent expense it, but now they're moving it back to prepaid rent. That's stupid. Why would you do that? I guess some people's children are going to screw that up. Don't do that. But if there's a question on there that you guys find that I didn't catch, please let me know, because I will not. I don't like that. Why would you even do that? I don't know. All right. Cash received, right? Deferred revenues. Okay. So we had deferred rent revenue. We got money from that company that we're leasing, subleasing. So we only are earning $250 of that, because we only earned, because they came in halfway through the month, July 16th. So we can only record $250 worth. All right, this one is oh, this is the next. Oh, this is if the alternative. I don't know how I didn't catch those. Okay. Salary expense, salary payable, $5,500. Okay, this is just what we paid at the end. This is what we owed them. We'll pay them in early August. Interest on that note we took out. We had 2 notes. That's yeah, this is an expense. I'm sorry, it took me a second. I had to reread it because I was thinking I did it wrong. But yeah, so we owed there were 2 notes, both of them were 10% anyway, so it's no big deal, but $333. Yeah, okay. Accrued revenues, revenues that we have earned but not received for. So we're going to debit the receivable, credit the interest or the revenue. I mean, so if we loan some money out, I guess, so we're getting money back. Okay, so prepare an adjusted trial balance. We made all those adjustments, and now we're making them reflect here. This is our unadjusted. Here's our adjusted. Now we got some additional accounts. Again, if you need to see the alternative text, please click that button. Oh wait, there's no on this one. Oops, too fast. Okay, so comparing the financial statements. I forgot the L on that one. Dude, I swear, I thought this book had been around a while. I don't know. Anyway, income statement, statement of comprehensive income, balance sheet, statement of cash flows, statement of shareholders' equity. Statement of comprehensive income is something that you haven't been taught either. It starts with your net income and then goes through some additional aspects of the company. Okay, it's not directly related to operations. So let's talk about those. Here's our income statement. We calculate and go through here and find our net income. It should be stuff you're used to. Revenues minus expenses equals operating income minus other income or expenses from other operations. You got your net income. But our statement of comprehensive income, all right, is we're going to be dealing with things that are excluded from our income but need to be reported here. So like if we get rid of one of our parts of our company, so let's say we're Microsoft, we decide to spin off or just get rid of the micro land because we were trying to do a theme park and we decided now this was a bad idea, just spin it off. That'll be a something that'll be a loss from discontinued operations. Things like that will be put on the statement of comprehensive income. Balance sheet, remember we do classified balance sheets, current assets, current liabilities, non-current assets, long-term liabilities, equity, things like that. So there's our balance sheet. We have current assets there, total current assets, property, plant, equipment, total assets, our liabilities, current, long, stockholders' equity, we balance. Statement of cash flows, we have our operating activities, investing activities, and financing activities. Remember those order is Operation Iraqi Freedom, OIF, operating, investing, financing. We do the indirect method, therefore. Oh, this is the direct method. You probably learned that, I guess. Direct methods are like really easy. So if we're doing the direct method, and super easy, barely an inconvenience. Anyway, I like the indirect method. You get to do more work on it, and it's fun. I like it. Anyway, I'm a nerd. Here is your statement of shareholders' equity. We're showing our beginning balances of all of our accounts, showing our ending balances, applying that to the income or the balance sheet. Closing, remember to close all temporary, reducing them to 0, closing them to the income summary, and then eventually to retained earnings. Oh, it says temporary accounts balances are closed to the retained earnings. Okay, let's do it. This book's a little different. That's fine. Either way is fine. Assume that financial year ends here, sales revenue, rent revenue close to retained earnings. And then our credit to all of our expenses, debiting retained earnings. Yeah, I mean, they're just cutting out the middle, man. We don't need the income summary in this sense. That's fine. It's just 3 journal entries now instead of 2. Retained earnings, debiting that, crediting dividends. And here's what your ledger account looks like. Beginning balance plus revenues minus expenses minus dividends equals ending balance. Start off with 0. Now you're at 1,917. Might want to rethink that dividend. I'm thinking. And your post-closing trial balance shows the debits and credits for all of your balance sheet accounts. Okay, I again forgot to cut out this. I'm not converting from cash to accrual or the other way around. Not teaching you about a worksheet. Definitely not reverse entries. Subsidiary ledgers. No, you guys know how much I hate these special journals. Yeah, yeah, no. All right, that's it, guys. Oh, I forgot to do the word. Whoopsie. The word is bride, like if you're bride, it's just bride. BRIDE. B is in boy. Oh wait, no, it's Bravo, Romeo, India, Delta, Echo. Sorry. So normally I don't give them to you at the very end of the video. I guess you got me on this one, but here it is. And good luck. We'll see you guys in chapter 3. Yes, 3.